Hello, you're with Colin and you're watching Grad School TV. This is Corporate Finance Module 4, and this week's question seems to be a rather tricky one because the answers in the discussion board don't seem to be very consistent. So who knows, maybe my answer will be equally as inconsistent. Anyway, given the difficulty of writing down formulas, I thought it would be easier again to do a video. I think videos are always easier, but Sal Khan has already proved that concept. So thank you, Sal. Love your work. But anyway, back to the question. We have a machinery outlay here, up the top here, of $400,000. We know that new working capital is coming into this project over the life of the project of $40,000. So we're going to say that our total initial investment is the sum of those two figures, which is $440,000. The annual depreciation figure, the machine is being depreciated to 0 over 10 years, so our annual depreciation will be $40,000. Our annual sales, which is a given figure, is $240,000. Cash operating expenses of $110,000. So we have a net sales figure here of $130,000. Then out of that net sales figure, we're going to have to pay some tax, which will be 30%. So that is 0.3 of $130,000 because the corporate tax rate is 30%. And then we have this thing called the depreciation tax shield, or our depreciation tax saving, which is going to be 30% of our depreciation figure that comes into our P&L statement according to the notes. Now, I found this concept quite interesting. Now, this will reduce the amount of tax that we have to pay. So what is 30% of 40,000? That's 12. So if I had to pay $39,000 tax, but my tax saving is $12,000, I'm going to make the assumption, now this is where I'm kind of guessing, that the net tax payable is actually only $27,000, which is this figure less this figure, 39 less 12. Which gives me my net annual cash inflow of $103,000 once I've taken into account my tax figures. Now, I know that all my cash flows are going to be the same except for year 10. That's where things get interesting as well, because I know that the project or the machinery has a salvage value of $50,000, but it's been depreciated to 0, so its book value is 0. So if I'm going to sell this, I'm going to have a $50,000 gain upon which I have to pay some tax. The tax is 30%, so that will be 50,000 times, well, I've put a minus 0.3 in there, which will give me the tax as a negative figure, so I can just sum those figures. And that gives me a net gain of $35,000. So, coming over here, I have my initial outlay, which is $440,000. I have my annual cash flows, which is this figure over here, of $103,000, and that fills all the way down except for year 10, where I have $103,000 plus the salvage value. That's going to come in as a terminal payment there. The salvage value coming in to add to my annual cash flow. Now, interestingly enough, we can see here that this question initially didn't provide us with a discount rate. So what can we actually calculate without a discount rate? Well, we can actually calculate an internal rate of return because our friends at Microsoft have provided us with this fantastic formula. I think our friends at Apple have done that as well in the numbers application, but we'll just thank Microsoft for this one because I'm using Excel. And we can calculate the internal rate of return, which is effectively all of these numbers. And that gives us an internal rate of return of 20%. Now, well, that looks kind of okay because the internal rate of return is the maximum that I could afford. And if my required rate of return is less than the internal rate of return, then I'm okay. So since we didn't actually have a discount rate to begin with, let's try one out. I've got a little cell down here ready to go. Let's try putting in 10%. Which also happens to be the figure that was later added to the discussion. If I then try my net present value calculation, I'm going to choose my discount rate of 10%, and then I'm going to choose all of my figures, my annual sales figures, and then I'm going to add in the initial outlay of the project, which gives me a net present value figure of $206,384.43, which is a positive figure and looks pretty good. So based on this decision rule and these numbers, one would accept the project. Now I think my overall rationale is okay. I think I might have a few problems in some of the detail over here. I think that's where things could have gone a little bit awry. So I'm looking for some feedback, and if anyone can help me out, that would be fantastic. But overall, I'm saying, yes, I think we should accept. So please write me some feedback. I'd love to hear what you all have to say. You've been watching Grad School TV.